What's up, people? This is Agent Cory Banks, Realtor 007. And today, I am going to sit down with one of my lenders and good friends, Scott Eisgrau. And we're going to talk about house hacking, but from the lender's perspective. Now, disclosure, we may talk about some other things because when we sit down, our conversations just tend to go different places, right? So just bear with us. We'll be okay. But the main thing, we're going to talk about house hacking and from the lender's perspective. Once you guys follow me and let's get the conversation started. Come on, let's go. Scotty, what's happening, my man?
It's great to see you, Corey. It's been a long time.
I know with COVID, we haven't gotten a chance to sit down like we normally do and just have these discussions.
Yes, sir.
So let me introduce real quick. This is my guy, Scott Eisgrau. You may hear me say Scotty, but you know, that's how we get down. And well, first, tell me about yourself.
So I'm a loan officer and a branch manager for Atlantic Coast Mortgage. I've been in the mortgage business since 1990. So I've been around. I've seen a bunch of different markets, just none like this one.
Mm-hmm.
And, just love to help people get home.
Right. Now, you said you haven't seen a market like this. What do you mean by that?
Well, this is kind of unique. It's different than the market we saw in the early 2000s.
Mm-hmm.
That was caused by easy borrowing, easy lending, right? If you could fog a mirror, you could get a mortgage loan.
Right.
It ain't like that anymore. So the mortgage qualifying is more difficult. And, we look at all aspects of the buyer and the home now, where before, if there are 5 boxes to check, we were happy checking 2 or 3.
Right.
So it's very different. We're seeing appreciation, but I think some of it's pent up. I think it's very good because I'm hoping that some of these people that got trapped in, from buying in '06 are able now to sell and move again because, the values of the house has plummeted. Now, paying on the mortgage for a bunch of years and the appreciation, hopefully those people will be able to get out of their houses and we'll see a great spring market with lots of inventory.
Yeah. I saw a post from one of my fellow realtors, right? And what it said, it was they purchased a house at $800,000 last year, right? And put it back on the market this year, and they got an offer $200,000 over than what and that's unheard of.
Yeah, it's crazy.
That's unheard of.
And I'm seeing even in that market, it's competitive. So I just wrote a letter for a lady at $850 on an $800,000 house. Okay, and it's gone. She didn't get it.
Wow.
So it went on the market. She saw it the same day it went on the market, and 2 days later, all we know is it probably went for more than $850.
Well, if it's anything like what I just experienced, I had 2 properties I put on the market a week apart. The lowest offers I got was $20,000 over ask.
Wow.
For one of them, they offered $60,000 over ask.
That's nuts, isn't it?
Right, exactly.
It's been crazy. I used to write maybe 1.2 letters per client. Maybe 1 out of 5 didn't get their first house. I had to get the second. Now I write letters all day long.
Right.
Probably averaging 5 or 6 letters per client, so that it's just so competitive. I've been advising clients from the mortgage side, think of that asking price as the opening bid. It's an auction. Right? 37 people want this house. You've got to put your best foot forward, whether it's paying the transfer taxes, whether it's paying all the sellers' closing costs, waiving appraisals, waiving home inspections. It's crazy.
Right.
It wasn't like this back in, 05, 6, 7.
Look, and real quick, let me be clear. The conversations that we're having right now, these are just normal conversations. This is not even an interview. We're gonna get into the other stuff, but these are regular conversations that Scott and I have on a normal
fairly regular basis.
Exactly. But yeah, going back to the types of offers that you have to make. I mean, yes, they are waiving inspections and things. And what happens is, I tell my clients all the time, even my investors, make your first offer your best offer, because it may be your only offer that
Right. Escalation clauses aren't working.
Right.
I mean, it's a market like I don't know that we've ever seen.
Right.
Like I said, I've been doing this 30 plus years, and I've never seen this.
Right. Look, and I have my speculations. We can talk about that later as far as what I think, because I'm looking at DC, I'm looking at California, I'm looking at these other markets and how they never came back down. And I just see some things in the Maryland and Baltimore market, but
Well, I read an article yesterday in the Wall Street Journal that said the average home price across the United States is just top 300,000.
Ooh, yeah. So
and it was talking about if you own a home and you're buying another home, it's okay.
Right.
But how difficult it is for people that want to buy their first home to now buy a home because of the money that's required to buy a home.
Right.
So yeah, it's definitely interesting, and I'm excited to see where it goes.
I am as well. I'm just keeping my eye because I have to. Because I have to go back, and when I speak to my clients, the investor clients, the retail clients, I have to have different conversations with them.
It's crazy.
And my investors, they get excited. They're like, yeah, it's a seller's market, I'm like, yes, it is a seller's market. However, at some point, you have to be a buyer too. So you're gonna feel it. You're gonna feel it in a good way once you go to sell. But when you have to go back and you have to buy, and
right.
that's causing me to be a lot more creative in the way I'm finding deals and what I'm doing.
Right. And if you're stepping up, what you're going to need extra on the purchase is going to be more than the extra you got on the sale.
Right. Right. So it's
tough.
Yeah. One thing I have found, and I'm speaking to a lot of my younger clients, and just clients in general about this, and we talked about it, right? In regards to, we always talk about the fact of house hacking, right? And let me be mindful that we have company that's listening. If you don't know what house hacking is buying a multi-unit. Normally is 4 units or less. You're gonna live in one unit and rent out the other units, right? And as the conversation we were having last week, my thing was, I always talk to the investors from the investors' point of view. I've always talked from the agent's point of view, and things like that. But very rarely do we hear about that from the lender's point of view, which is the very important piece.
Sure.
Because what many people don't understand or don't know, you can still purchase a building 4 units or less with FHA as just like a single family home, but it's just different factors that will go into play. So let's talk about it.
So it's really pretty cool, right? So you have different types of loans. You have primary residence, you have investment properties, and you have second homes.
Right.
So let's throw away second homes.
Okay.
So when you're talking about a primary residence, all it means is that you're going to live there. So whether it's 1 unit,
there's a misconception, and you have different people, especially from the agent's perspective, when it comes to FHA. How long can you live in that property before you can use it as an investment property? What's the minimum amount that you have to?
So when you go to closing, one of the documents says that you intend to live there as your primary residence.
Right.
Okay. It's widely accepted that's a year. Okay. So I would say that you're safe if your plan is to live there over a year.
Okay.
So 203K loans. I've had investors come to me, tell me they're going to live in the house. We do a 203K, and then I get a call 6 months later saying that they want to do a 203K, that they're moving out.
Right.
That doesn't work. It doesn't work. That your intention was never to live there.
Right.
You want to be able to say with a clear conscience and prove that you live there, that that was your intention, that that's what you were going to do.
Well, I'm just saying, now what is closing costs on 800,000 from the lender's perspective?
It's probably going to be 20 to 25 grand.
All right, 20 to 25 grand. So let's go back to that scenario.
So let's say 50, because 20 is 2.5%.
Right.
We need 3.5%. So figure 50, 55 grand puts you in an $800,000 4-unit property.
Right.
And in Baltimore, that's a palace.
Right. Now divide that by 3 or 4 friends, right? And now the 3 or 4 friends are in this building. You all on it together, and you're paying the mortgage, but at the same time
you're collecting 3 rents.
Exactly. And but collectively that payment is smaller, right?
Right.
And then eventually you guys are making more money.
Well, look, if they live there, right? If it's, let's say it's 3 guys and 3 of them are living in 1 unit,
right?
They're living for free. They're making money on the rentals,
right?
Okay, I mean it's a almost can't lose situation.
Right.
The way that you lose is if you don't keep your units full.
Exactly.
Right. So you either better be able to put people in there or get a property manager that can.
Right.
But it's not that difficult. Rents are through the roof right now.
Like they're negotiating rents.
I'm seeing townhouses in Owings Mills renting for $2,500. That's nuts.
Well, this is what I see. I see them. If the listed rent is, let's say, $2,000 a month, I'll offer you 23. I'll offer you 25. Yes. Or I'll pay 6 months in advance. It's just the market is so crazy. So in a situation like that, if you were to get in, if you were already in, you're good, because now most people are going to live in that property for at least 3 to 5 years.
Yeah.
And if you're doing right by the screening and the beginning, that means that you're gonna have an easier time with this tenant.
So I think the biggest mistake people make, especially first time investing in multi-units, is going too low. Right? If you buy a low priced property, you're going to get lower rents. You get a lower quality renter. And you have to remember that I keep saying, as long as they're rented,
right?
It doesn't matter the purchase price. And when you're talking about, even a $400,000 or $500,000 multifamily, you're in a better neighborhood. You're attracting better people. And remember, you're living with them,
right?
So it's just. It blows my mind. It's just a great way, especially to start in investing.
Right.
If you own your home now and you want to buy a 4-unit property, chances are you're not turning your primary into a rental to go move into a 4-unit property.
Right.
Well, people say that to me, and I think they're just lying.
Right.
And if I do, the underwriter is going to think the same thing. Right. So you can't get away trying to do that. Right. It's got to be your primary. But it's like gold.
Yeah, look, I'm talking to my niece about that now. She's like, well, I want to move. I'm like, instead of another rental property, let's do it. You're already comfortable in this type of. Let's put you in a situation where you actually own the building, and now you have more, more growth in that particular potential situation. So. Just the education part, man. The education.
Never stop learning.
Right, exactly.
Never stop learning.
Exactly. And now, and that, again, from the lender's perspective, now you've acquired this property, is making money, and now I want to go buy another property. How does that look on my credit, or from the lender's perspective? I have this property, it's an income producing property, and now I want to buy my primary residence that I'm gonna live in. How does that either benefit or affect or hinder that process if I were to buy a primary residence coming from house hacking or having that?
So what happens is, again, it goes back to the rent on the property will offset that mortgage payment.
Okay. So
we use either 75% of the rents okay? Or if you've had the property for a number of years, we're going to go to your tax return and look at your Schedule E and take the income from there. So if we're taking the income from the Schedule E, we use the income. Okay, so let's say your payment's $2,000 and your income's $2,500.
Right.
It offsets that mortgage payment, and you have $500 positive cash flow. So now when I'm looking at, you're buying this $500,000 house, basically I'm just pushing your investment property aside because it's covered. It's covered by the rents.
Right.
So you're going to qualify based on your income and your assets. Now, one of the things that we recommend is that on this 4-unit property, once you start building some equity in it, that you refi it out of an FHA to a conventional loan, because if you have 20% equity, you're ditching that FHA mortgage insurance.
Right.
Even if you have 10% equity, okay, while it's your primary, you can refi and the mortgage insurance will drop dramatically. So a lot of times I'm helping people buy these 4-unit properties. They live in them for a number of years. They meet a significant other, some life-changing event where they don't want to be there anymore.
Right.
They're buying their, people say their forever home.
Right.
Okay, unless it's a dirt basement, it ain't a forever home.
Right.
So they're moving out of this one. The rent covers the income there. They've got equity. We refi that to conventional, hopefully drop their payments significantly. Okay, and you can do that without any money if you have equity.
Okay.
Then we move over to their primary residence, and again, we're looking at a conventional loan typically. You can do a conventional loan with as little as 3% down.
Okay.
Okay.
Right.
So I say 3 to 5% down on that property, and now you've got your primary residence. Or, if you bought this house when you were 21, 23, 25, and you were there 3 years, okay, and you want to do it again, you certainly can. Okay. Again, you can only have one FHA loan at a time. So what you can do is either refi it to conventional, or if you don't have the equity, you leave it FHA, and we look at the next one conventional. FHA is a little bit easier in these situations, but there are ways to do it conventional with 5 to 10% down on multi-units.
So now we're talking about refinance. So let's do this. Let's do this here. Let's put a pin in the refinance, because what I want to do, I want to schedule another talk, because we talk about the Burr method, and I want to talk about the Burr method from the lender's perspective.
Okay.
Again, we're always talking about from the investor's perspective, from the agent's perspective, but I want to hear it from the lender's perspective.
Absolutely.
So let's schedule another
Cory,
time to sit down.
Thank you so much for doing this with me. I really appreciate it.
So we're going to wrap up. Next time we're going to talk about the Burr method and refinancing. This is my man.
Thank you very much. You want me to say my name?
Just say your name, man.
Let's try that again.
I'm not going to edit it, because we can do it just like that.
Scott Eisgrau.
There you go. And it is Agent Cory Banks, Realtor 007. I'll check you at the next video. Have an amazing day, and I'll check you later. All right? Nah.